Sam, talk to me about earnings. We've had some really upbeat releases, but right now we're looking at a bunch of names: Netflix, Qualcomm, eBay, Amgen. There's a bunch of forecast issues here, and we're seeing a bunch of lower trades in the pre-market, the aftermarket. Does that kind of surprise you here, based on what you've been seeing in terms of those earnings forecasts?
In terms of the earnings numbers, no, it really hasn't been surprising me, because we were really expecting a very strong year-over-year quarter, actually to be the strongest year-over-year percentage change for the entire year. But the revenue growth was still likely to be in question. So we were expecting maybe about a 13.5% increase in revenues year-over-year. It's coming in actually in the high single-digit area. We're not getting the guidance that I think a lot of companies and investors had been hoping for. And also from the earnings standpoint, if you are on target or even higher by a penny, maybe 2 pennies, then the street tends to say that's not good enough. It has to be even greater than that, more like 5 percentage points or more. And
then we see, the forecast issue, eBay here, second quarter operating EPS 37 to 39 cents. The estimates for 40 cents. I think a lot of people, when they think of forecasts from this earnings season, will not forget Apple. They always kind of come in a little bit light, but it looks like today, at least that's becoming a trend, a little bit light on the forecast. Is there a concern, Sam, that this is kind of the peak? I mean, obviously it's going to be a big jump over last year, but is this kind of the peak that we're seeing as far as EPS and revenue growth?
I believe it is a peak in terms of year-over-year percent change. It'll still be positive as the year goes on, but the magnitude of year-over-year differences will be lessening as the quarters proceed. So in terms of how excited am I going to be, how surprised might I be, right now we're looking at more than 83% of the companies that have been reporting coming in at better than 2% or more on the upside, and I think that is a fairly large number by historical standards.
But Sam, when you look at valuations, you've got the S&P trading at 14 times projected earnings over the next year, the lowest valuation since 1990 if you take out the credit crisis that we just went through. I mean, what do you make of that valuation? Do you think equities, based on that, are a good buy, and based on kind of the earnings numbers that you're seeing so far?
I think the right answer to most financial questions is that depends. If somebody says to me, are stocks expensive? Well, that depends. It depends on what you're looking at. If it's operating results on a trailing 4-quarter basis, we're at a shade below 16 times. That actually is a nice, or a shade below 19 times, which is a nice discount to the average of 19.5 going back to 1988 when we started capturing operating results. But if you're looking at GAAP numbers or as reported numbers, and you go back to 1936, we're trading at about a 35% premium to that number. I would tend to say most people do look at operating results. They look at projected results. And right now, if we even just had a PE of 17 on 2010 estimates, we could justify a 1325 level on the S&P 500.
Sam, what if you look at 2011 estimates, and it's kind of volatile if you look at the PE on S&P earnings here. Yesterday it was 14. Today it's 15.25. It's still fairly low, or at least sort of middle of the range, though, historically, isn't it?
Absolutely, but you're also looking 2 years out. 2011 numbers of $95 for the S&P 500 gives you a very attractive PE ratio, but I think most people are still waiting to see how realistic the 2010 estimate of $80 is likely to be. So when you start throwing in 2011, I think that's a little bit too far down the road.
Or we hear 88 or more from Barton Biggs and Jeff Sott.
Right, we
do.
Are
people too optimistic here, Sam?
I think from a sentiment standpoint that we are getting to very high levels. Our chief technician, Mark Arbiter, points out that the consensus poll shows more than 75% bulls. The last time we were at that level was October of 2007 at the prior bull market peak.
All right, we got to run. Hey, Sam, good to get some time with you. Break down these earnings. Sam Stovall over at Standard & Poor's.
Sam is an encyclopedia of data. By the way, he writes down these numbers at the close of the market every single day with a pencil and paper.
Gotta love it.
It's amazing.